Hey, everybody. Welcome to the morning market briefing Monday, April 18th, 2022. We were just talking in our pre-production meeting. If you haven't paid your taxes yet, it's a good day to do it. Last day to do it. Get those checks in the mail. I got to do mine. Waiting to the last minute. So get rolling on that. How was everybody's weekend?
I'll jump in. It was good. It was long. Went to the zoo on Friday. No big deal. Saw some pandas. Pretty electric stuff.
Did you see the red panda?
I did see the red panda.
They're very small.
They are smaller than you think. I think the highlight of the entire trip was probably they have these little red lion monkeys, which are very energetic, which were a real hit with Molly. So pretty wild weekend.
Yeah. Ben, see any animals?
No animals.
So just chilling. Good. Well, hope everybody had a good Easter weekend, all that good stuff. Lots to chat about today. Very busy week. Lots of earnings coming out. Right now, futures are down just a smidge. Dow futures down 8 basis points. S&P futures down about 30. NASDAQ futures down 57. It does seem like a week where we're going to be paying a lot of attention, not only to earnings, but also commentary tied there too. But we're going to open up today. DiDi, the Uber of China, is delisting. DiDi delisting. Vote coming on March 23rd to delist from the New York Stock Exchange. Just a disaster of a story. I think it IPO'd at 15. Stock moved closer to 20, it looked like, based on the chart. It's at $1.99 right now, and this is all transpired in the last year, less than a year. Ben, talk to us about DiDi. Where do they go from here? And if you're an investor, one, why are you still in it? But two, when are you just dumping it? I guess right as soon as possible.
Yeah, I think that people are dumping it. I mean, they're going to delist, and the thing is, what they're doing is they're going to delist from the US, but they're not going to relist internationally until after that US delisting is done, which means that it's going to be a race to the exits even now. So what little money people have left in it, they're just going to be getting out of it. It doesn't help that their revenue was down 13% on a year-over-year basis. It's tough to manage a company that deals in travel and ride sharing and ride hailing when people are still getting locked down because of COVID in Shanghai. So that Shanghai might be opening up, but it's way too little too late for them. And DiDi is being delisted from the US.
Yeah, it's a terrible story.
Do you think that there's any, this is at all anticipatory because things are so locked down right now that rather than have them be listed during that time, the next earnings report, that they just say, hey, it's going to be so bad, we don't even want to be able to trade at that point?
I think it's just been bad for a year.
Yeah.
In my opinion, they still got revenue down 13% on a year-over-year basis. So, it's down 82%.
I don't know. Have either of you watched Super Pumped I think it's on Showtime. It's one of those pseudo accurate stories about the start of Uber and kind of the battle there with Travis. I'm blanking on his last name, CEO. But a big storyline there is them trying to infiltrate China and how many people in the rideshare community was just actively ripping off Uber. They'd have 30 phones in their car logging the same trip, that kind of thing. And basically in a very coordinated way, making sure Uber did not succeed so that the Uber of China would. And it's just interesting to see that play out over the last couple of years and see it not really succeed.
Interesting.
So,
I think that lends us to our next topic, which is pretty easily.
Yeah. Staying kind of on the topic of China, Starbucks, been interesting. CEOs now really blasting false promises made. I got very, very frustrated with Starbucks. I think it was maybe second quarter of last year. Just listening to their conference call, data coming out of China was pretty horrendous. It was terrible. It was not up to expectation or guidance that they had even set for themselves. And yet the overall tone was, we really like what's happening in China. We think we're executing well. We've nailed it. Ben, how much of this is Starbucks trying to change corporate messaging to try to get investors back on their side? And how much of it is, frankly, an honest self-assessment?
I think part of it is honest self-assessment. Part of it's Howard Schultz, just trying to make himself out to be the Messiah. And part of it's also in response to the union efforts at Starbucks. So what he's promising is that He's going to say, we're going to fix some issues. So some of the issues that they're going to fix are maintenance people not showing up on time, training, wages, and other issues. And he says, we need to reimagine the customer experience, reimagine the partner experience, the employee experience, reimagine the third place experience, and reimagine mobile order and pay, reimagine the drive-through. So basically they're reimagining the Starbucks concept as a concept. Maybe they're not changing the coffee, but apart from that, they're changing everything else. And it's going to really have an impact on a lot of employees. And he's trying to make the message that, hey, this is going to be really good for employees. Therefore, for the long term, it's going to be good for shareholders. I think that if you're owning Starbucks, you got to look over the very long term at this point in time, because I think there's going to be a digestion period there.
Yeah, I think it's going to be uglier before it starts to look better. And this is a stock that was at $125 and change last summer. It's at 80 now. Tom, former Starbucks employee. What are the optics?
I just think that, I mean, if you look at Starbucks now versus when I worked there, it's just a completely different vibe. There's a super limited menu. Everything was super high margin. I mean, they make so much money on a single cup of black coffee versus all of these other extraneous items. We were looking at Dutch Bros, which is a sort of a startup West Coast coffee franchise, and they don't sell food at all because the margins on food are so much lower than they are on coffee. So they're just being exceptionally streamlined, and I think that's the best way to do it. I think Starbucks has just gotten lost. I think they're trying to do too many things at once. They're basically becoming McDonald's. I mean, if you look at something like Chipotle, where they have 7 inputs and they could have 8 trillion combinations, and everything is easy to make because you've only got a couple of ingredients. They dominated for so long, and then people have got lost in McDonald's because they've got 95 different menu items. And I think Starbucks has gone that way too, where there used to be 5 or 6 inputs to make all of the different coffees, and now you've got just a million different things. You've got a million different food items. They're trying to push all kinds of merchandise, and I think they've just gotten lost. And then the China thing is just, I mean, they continue to just pour money into that black hole, trying to find a location where there aren't many Starbucks and expand, because we've got 20,000 stores in the US. That's an impenetrable market, and I think they just need to give up on it. I mean, they're worse at invading China than Russia is in invading Ukraine.
Great analogy there. Starting Monday off on a lighter note. Good job too, because we didn't actually have Russia, Ukraine on the agenda, but we were able to talk about it anyway on the call. Got to get it in, so the streak continues. Switching gears, housing market. We talked a lot about this in a macro presentation. It is up on the blog if you want to go back and listen to it from last Tuesday. So check that out, share it with your friends, watch it with your loved ones, all that good stuff. But we talked a lot about housing. Obviously, in the rate environment that we are in, we have seen mortgage rates really just skyrocket at a rate much quicker than I think anybody could have anticipated. We had a client that was selling a home and buying a home in December, and she was not real enthused that she got locked in at a 3.1. She thought she should have been, a 2.95, something like that. And in hindsight, 3.1 looks pretty darn good a couple months later. That's going to have an impact on purchasing power for people, and could potentially cool the housing market, which has really just been ramping up and ramping up and ramping up for the last 2 years at a really exaggerated level. Ben, what data are you looking at that may potentially suggest a little bit of a slowdown on housing, and how sustainable do you think that might be?
Yeah, so you've seen some more articles about this, so we thought we'd bring this to the attention. You are seeing year-to-date growth in home tours measured by showing time. That fell 3% on a year-over-year basis. You also have, at the same time, you're having a lot of people continue to buy homes in cash. 25% of existing homes were purchased in cash in the month of February. And we're seeing price drops become a little bit more common. They're still rare, but they're becoming more common as homes sit just a little bit longer. So I'm looking at home tours down about 3% year over year. I'm looking at price drops, which are coming a little bit more frequent. Having said that, there's still a lot more demand than supply. Even if demand gets cut by half, you might see 8 showings versus 16 showings. You're still seeing a lot more demand than supply for those homes. And I think that this economist from Cocoon, a real estate data firm, actually says it pretty well. We're going from a gangbuster market to one that hopefully looks a little bit more normal. So I would expect that's where we ultimately settle out. As you approach normalcy, that slowdown could get a little people concerned because people like to extrapolate trends. And if you go from 5% to 4% to 3%, people will continue to extrapolate to 2%, 1%, 0%, negative, 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 and make illusions back to 2008. I don't think that's what's going to happen, but that's something that we could see people extrapolate and therefore have impact on the market. So it's something we're watching. We'll continue to watch it. Right now, our base case is that we're going from gangbuster to normal. We're seeing a little bit cooling in demand as a result of higher prices, as a result of mortgage rates. That's not really unexpected, but we're now seeing it.
On the rate side, Tom, anything that you think could kind of slow this ramp up we've seen?
I mean, really, I'm not sure what the top is. I mean, we spoke at the macro last week and interest rates were at 4.75 on their 30-year fixed mortgage. And, by the end of the week, they were over 5%, closer to 5 1/8. And I'd said that I thought 6% was kind of the top for the year, but I mean, we're getting there much more quickly than I thought we would. But I think that there's got to be an upper limit. Once we get up to 5.5, 6%, I think that it's going to be very difficult to keep pushing higher without just tremendous cracks in the market.
Because the flip side is that the Fed knows about the wealth effect. And if you're seeing home prices start to fall because the mortgage rates are so high, then that negative wealth effect is very similar to 2008. And when you have declining equity in the home, you have a lot less purchasing power. And that really creates this deflationary narrative. So you could have this is why bubbles happen. They have big run up, then they explode. And then you have on the flip side, you have that deflation, which if it's debt financed, that's when you have the bankruptcies.
Yeah. Because even when we've talked about looking at the affordability charts over the last 30 years, when, interest rates were at 15%, home prices were extraordinarily low. And when, interest rates were at 2%, home prices were extraordinarily high, but the ultimate affordability is roughly the same, if not slightly lower. And so, either one's got to give. The higher interest rates go, the slower the growth in pricing will be.
Yeah, and I think the Fed knows that. I mean, kind of to Ben's point, I think they'll be, I guess, somewhat proactive. I mean, I think the potential positive that could come from this, I do worry about the people out there. And I think we talked about this a little bit in the Q&A section of the macro. I can't totally recall. It all blurs together. But I think we talked a little bit about the people I'm most worried about in real estate right now. And I'm not talking about real estate investors. I'm talking about everyday people, or the people who've seen tremendous appreciation in their home value over the last 3 to 4 years. They're saying, hey, I'm going to capitalize. I'm going to sell high. I'm going to buy a bigger home, a nicer home, whatever it may be at an equally high price. But I'm going to roll all that equity into this new home and have, something close to the same mortgage payment and feel like I've really gotten ahead. Those are the people that I worry about on a personal level, because they don't need much correction in home prices to be underwater. If you're sitting in a position in which you bought your house a couple of years ago and you have 50% equity in based on what it's valued at right now, you need a very steep correction to before you're ever underwater. So in a way, I think if we could slow some of that more speculative personal ladder climbing, I think that could probably be a positive thing overall for Americans' personal balance sheets. And so hopefully that's a positive outcome of this. We'll see kind of how that plays out.
Tom, I'm curious, as you think about the Fed's reaction function here, they have $1.5–2 trillion in mortgage-backed securities on the sheet. They're running off $35 billion a month. That's what the expectation is. Do you think if you see mortgage spreads relative to treasuries continue to widen, do they hold back on that? Do they start reinvesting some of those principal and interest payments a little bit more in order to stabilize that market? Because right now it's like persona non grata in terms of investing in mortgage-backed securities. And I wonder if we're going to reach a point where the Fed says, we have to remain the lender of last resort. We can't let these mortgage rates get out of hand.
I think they definitely have to consider that. I think that right now, what the unknown is, what does the profile of the mortgage-backed securities look like that they own in terms of maturities, coupons? I would love to see an analysis of that, because if I were them, how would I be attacking this? I'd be trying to sell stuff in the 2 to 5 year range, and it's short. I'd be trying to find places where I could effectively unload balance sheet, but not be affecting the longest of the long on the portfolio. But the problem is, as rates rise, the duration on mortgage-backed securities actually increases, because you've got what's called extension risk. And so the longer you hold on to them, the more duration you're going to have, the more they're going to affect the bond market in terms of the long end.
Good stuff. Tom, sticking kind of on your side of the world, state of New York upgraded on the fixed income side. What happened there and how's that impact portfolios?
So, we've talked a lot about opportunities over the last couple of years. Where's the value in the bond market? And so traditionally speaking, New York bonds trade below scale, which is the average AAA muni that's 10 years long is yielding 2%. New York bonds typically were trading, 20 or 25 basis points below scale, which means that, you're going to have to pay up for those. And the reason for that is that New York's got a 10.9% income tax for personal or for individuals. And so, they always trade expensive. They're always very high. There's a lot of tax revenue. And when the pandemic hit, we saw New York pretty much get thrown out with the bathwater, which is that no one wants to buy New York. The headlines all say everyone's moving out of New York. No one wants to live there. But we're seeing that reverse. We're seeing that the income rates have gone back up. We're seeing cash flows at the state level come back up. And so New York has been upgraded back to AA1 today, which is one notch off of AAA after being downgraded twice during the pandemic. And so that's very beneficial because during the pandemic, New York has been trading way above scale. Which is to say you can get a lot more bang for your buck for a New York bond than you could for your average bond. And so the function there is that as that narrative starts to turn and we get back to the point where New York bonds are now more expensive than the average bond, we're going to see increased performance on those bonds. And it really affects nearly everyone because that's an area we found in the last year to be extremely valuable. You're buying, AA2 New York state GOs that are backed by the full faith and taxation power of the state of New York, which is very, very powerful. But the difference is that nobody thinks that at the time. And so now we're seeing that reverse, which is going to be very, very beneficial for performance.
Good deal. Slight camera tweak there. Producer Logan climbing over chairs to unplug a refrigerator. So if you heard some feedback earlier there, we're still figuring out the studio, but great work there. Very busy week. We're going to hear a lot from central banks. Bullard speaking today. A couple other folks coming out throughout the week. We get the beige book. We're going to hear Christine Lagarde and Powell at an IMF event. Tons and tons in earnings. As you guys are kind of setting the table for the week, I said this at the onset of the show, and I really feel like this is a week in which earnings and the commentary tied there too are going to be very heavily scrutinized, especially as we try to look at the impact of these major storylines like inflation, those kind of things. But what are you guys keeping an eye on specifically?
I mean, for me, we're seeing a normalization of the yield curve. I think any additional commentary we're going to get this week, hopefully will continue to show steepness. We're getting close to 40 basis point spread on the 2s10s. So we're seeing a normalization there. We're seeing the 30-year finally sell off, which we had not seen before. We're getting close to 3% on the 30-year. And so for me, I just want to continue to see steepness on the yield curve. I want to see commentary that's hawkish but guarded, which is to say they're going to raise interest rates, but they're going to do it in a way that is data dependent and not just on a one-way track with no looking back. And so that's what I'm looking for this week. Obviously we're going to be looking for cheap bonds and opportunities, but I think net with all the news coming out, we're probably going to continue to move higher on yields this week.
Yeah, I think hawkish with a data dependent tilt, I think, is the optimal. I think that we're probably going to get a little bit more hawkish without a data dependent tilt. This is the last chance that Powell has to talk before you go into quiet period before the May 4th meeting. He's going to be talking with Lagarde. Lagarde is just going to be copycatting a lot of what Powell does. So I think you're going to have a very hawkish week. It starts today with Jim Bullard. I mean, he's going to talk about we need 10, 11 hikes. So I think that that's something that we're definitely on the watch for. Having said that, that may be why futures are down slightly this morning. In terms of earnings, it's fairly light on the economic data front this week, but we do get a ton of earnings. We already had Bank of America this morning. That's up a little bit. This evening, we get JB Hunt. That'll be a really good read on what is actually going on in freight. We talked in the macro presentation, the freight stocks were down about 18% in a week. Is that the bottom? Was that a one-time deal, or is JB Hunt seeing something a little bit more meaningful? More clarity on that is very much needed. We'll talk about that tomorrow morning because they report tonight. Lockheed Martin reports tomorrow morning. What are they seeing on the defense side? Then tomorrow evening, we get Netflix and IBM. IBM is supposed to turn around a little bit. They made a large acquisition of Red Hat. Where does that end up going? They have a new CEO there. They need to turn on the cash flow machine. And then Netflix, if you recall, last time in January, Netflix was down, I don't remember, 25% or something like that. And you had then Bill Ackman, the large hedge fund investor, he ended up buying a large stake in that. So my guess would actually be they have arrested some of the declines in subscriptions that they were seeing, or at least deceleration in subscriptions. So I think you may have a little bit of a relief quarter for Netflix, but I'm not sure if they've answered all of those questions yet. Wednesday evening, we have Tesla. And then Friday morning, we have an American Express conference call, which I think will give us a really good state of the consumer, as well as the travel industry. American Express in January sounded great. And they sounded great when they were talking in late February, early March as well at a conference. So I expect good things from American Express. My concern is that so does the market. We'll see what happens with that, but general credit quality is pretty strong, and I think they should do okay. So busy week, and we'll see what happens.
Yeah, and I think one other I'm interested in is Blackstone. It's been obviously a very volatile start to the year. I'm interested to see what they show and what they print in terms of just things they're doing in the alternative space. I mean, it's a super kind of quirky company in terms of what they're doing. They're all over the place. They make headlines a lot of the times when we're talking about Merger Monday. They're involved in some capacity. I'm very interested to see kind of what they're seeing and what they're doing, and kind of the read through on the more creative side of, I guess they would say the more creative side of investing in what we do. So I think that'll be a good data point. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day and a great week, and we'll talk to you guys soon.